Hi guys, my name is Ryan, the Frugal Analyst. So before you buy or refinance your mortgage, make sure to understand these 5 factors affecting your mortgage rates and financing costs. The 5 factors are credit score, loan characteristics, property type, loan originator, and the debt markets. Now I'm going to explain each factor in great detail in this video. So the first factor is credit score. The higher the score, the better rate you're going to get. At 760 or above, you are going to get the best rate possible, and anything lower will cost you higher interest. Usually these score buckets are fixed and you want to get the highest band possible. So how do they get your score? Well, the originator runs your credit through 3 different bureaus: Equifax, TransUnion, and Experian. They all run the FICO algorithm, but each of them have different underlying database, so each bureau can give a different score, and they basically take the median of the 3 scores to determine the band that you're in. Now, most people know that FICO scores are dependent on payment history, outstanding balance, and credit history, so make sure to pay in time and have as little debt as possible. Now, what people don't know is that credit score is very, very sensitive. If you pay your credit card balance every month, that's great, but if you're getting a mortgage, pay them at least weeks in advance before they run your credit. In between the month of you holding a balance and the end of the month or the end of the statement, your credit will actually fluctuate, so it's best to pay it off early if you carry a balance, and even if it's only till the end of the month. The next sensitive item is inquiries. When you ask for more credit, your scores is going to drop temporarily. This happens when you apply for a credit card, a personal loan, a car loan, or even a mortgage. Your credit can decrease after an inquiry because it shows that you're looking for more credit and can be seen as a riskier borrower. So don't apply for credit cards, any loan before applying for a mortgage. And when you do apply for a mortgage, make sure to apply multiple applications at one time, like in the same day, so your score stays consistent for each application. So next is loan characteristics. Starting with the term, there's the 15-year, 20-year, 30-year loan. Basically, the longer the term, the higher the interest rate and the lower the payment. Then we have the rate type. There's fixed, variable, or ARM. Fixed rates are the most popular because it is a constant payment amount, while variable rate loans may fluctuate depending on the debt markets. We'll talk about the debt markets later in this video, but basically the cost of financing fluctuates over time. When you pick fixed rates, you are inherently buying insurance on the interest rate and therefore pay a slightly higher premium than variable. So technically, you can get a better rate using variable, but most people choose fixed for the constant payment amount. Now, the hybrid between the fixed and variable rate is called ARM. And this basically gives you a slightly better rate than a 30-year fix, but will switch to variable after a certain number of years. So if you see 10-1 ARM, it means 10 years of fixed rate. Then it changed into variable rates that gets adjusted once every year after the first 10 years. The next loan characteristics is purpose. Are you buying a new home? Are you refinancing? Or are you doing a cash out refinance? Now, buying a new home and refinancing will give you similar rates, but cash out refinancing usually costs a little bit more in interest rates. And cash out refinance basically means that you're taking some of the equity in your home back to your own pocket. And that is deemed as a little bit more risky than if you're buying a home or doing a standard refinance. The next loan characteristics is loan amount, and this is a complicated one. So the most important factor with loan amounts is the LTV, or loan to value. It is calculated as the loan amount divided by the appraised value of the home. Just like the credit score, this influences your interest rates. The less the LTV, the better your rate is going to be. And if your LTV is under 60%, you're going to get the best rate. Now, if your LTV is higher than 60%, your interest rates goes up. And especially if you're above 80%, you might have to pay PMI or mortgage insurance, adding cost to your mortgage. The next factor of loan amounts is the size of the loan. If your loan is too small, like if you're trying to get a mortgage for $200,000 or less, some originator might charge extra because they can't make much money on the loan. If your balance crosses the conforming loan limits, which is roughly $550,000 in 2021, and it's also depending on the location and it's revised every year, versus a jumbo loan, which is any loan number above that number, your rate can fluctuate. So if your balance is too low, you might get hit with higher costs so the originator can make more money. And if the balance is too high, you're going to get a jumbo loan and you might have slightly higher interest rates. So the best rate is probably for balance between $300,000 and the conforming loan limits. The next big factor is property type. So condos are slightly more expensive than a single family home. How you are using the home also matters. Primary residence will get the best rate, second home might have slightly higher rate, and rental property will be the most expensive. Location might also matter as you might have access to more or less lenders depending on where the property is located in. Speaking about lenders or loan originators, this is a big factor. So every company is different. They all have their profit target, different financing structure, and overall business costs. The rule of thumb here is to apply to as many lenders as possible. The lower their cost structure, the cheaper the deal you can get. If you see a TV advertisement, it is likely going to be expensive. I recommend using online mortgage lender because they are usually cheaper, or a credit union. So some people might be uncomfortable with online lender with no face-to-face interaction, but they are as good and economical. Now let's talk about how lenders make money. They can charge you points, a flat underwriting fee, or higher interest rates. All these three factors are related, and I would recommend asking for a no-fee mortgage or a lender credit to cover the origination costs. This usually bump up the interest rate a little bit, and I prefer it because who knows if I will change my loan before it matures. If they did not tell you the option with lender credits or no fee, ask for it. Not all loans are going to have a no fee option, especially the lower balance loans, but it is better to have the flexibility to choose the options that you want. Speaking about lenders, this video is sponsored by Credible. If you're looking to buy or refinance a mortgage, make sure to check out Credible. I saw my rates in 3 minutes with a soft credit pull that doesn't affect my credit. They compare rates from several lenders, and every application through the link and the description of this video benefits this channel. The last big factor is the debt markets. So getting a mortgage is like a fixed income trader betting your loan balance in the markets at one time. Timing is important, but you can always refinance if needed. The loan originator usually sells the loan to the debt market after the issuance, so the rate in the debt market dictate how much money they will get. If the loan rate is relatively high, the originator will receive more money based on the balance. Now, the closest rate we can follow is the 10-year yields. Why 10-year? Well, the mortgage is between 15 to 30 years, but most people don't keep it for that long. They might move, refinance, or pay it off early. The average life is roughly around 10 years, so we can look at the 10-year Treasury yield for rate movement. If this rate goes down, the mortgage rate will likely go down as well. Now, the mortgage rate will have a premium on top of the 10-year yields. So if the 10-year yields is here, the mortgage rate will probably have a little bit of a premium on top of that. So overall, understanding these 5 factors can hopefully make you become more strategic before getting a mortgage or refinancing. The most important thing we can do is to get the highest credit score. Don't apply for credit close to the mortgage application, pay off your balance early, lump multiple mortgage application at one time, especially low-cost internet mortgage lenders, watch the 10-year yields for rate movement, and if you have a mortgage, you can always refinance as many times as you like, but there are originator costs that you need to incorporate. So thanks for watching. If this is helpful, please hit the thumbs up and comment below for any questions. And I'll see you in the next Frugal videos.